Welcome to Breaking News to Trading Moves. When we look at modern commercial aviation, there is a real comfort in the concept of the autopilot.
Oh, definitely. You program the destination, the sensors engage, and the machine just flies a mathematical route.
Right.
It removes human error. A pilot's momentary fatigue or a sudden distraction doesn't bring down the plane.
Exactly. But imagine that same autopilot is rigidly programmed to fly directly into a Category 5 hurricane, simply because that was the designated flight path.
Wow, yeah, that would be a problem.
It would. Imagine the system lacks the sensors to detect the storm ahead. Suddenly, the very mechanism designed for safety becomes a rigid trajectory toward a crash. We are looking at a very similar structural reality in modern wealth accumulation right now.
So you're talking about blind momentum driving a system.
I am. Today, we are establishing a rigorous debate on a central question. Is the traditional buy-and-hold passive index strategy a reliable mechanism for building wealth, or has it become a structural trap that guarantees poor outcomes?
And we are clearly taking opposite sides here.
Very much so. My position is that passive index investing, driven by market capitalization, is mathematically flawed and detached from reality. It requires investors to adopt active strategies anchored in actual business valuation.
Right, and my position is that abandoning passive buy and hold in favor of market timing or rules-based methods falls prey to the insurmountable flaws of human psychology and institutional constraints. Steadfast endurance remains the only proven path to success.
Well, let's just examine the mechanics of the market right now. Stock prices are increasingly disconnected from actual business performance.
How so?
If we look at the Shiller PE ratio, which, measures market valuation by looking at 10 years of average earnings to smooth out business cycles, it is currently sitting over 40.
Which is historically a very stretched metric. I will give you that.
It's a high number. That means investors today are basically waiting more than 38 years just to get their money back from S&P 500 earnings.
Yeah, the earnings yield is pretty low.
A mere 2.6%. Compare that to a 4.5% yield on U.S. Treasury bonds, and the disconnect is quite clear. The peril here lies in capitalization weighting. This mechanism mechanically forces capital into overvalued companies.
Let's pause and explain exactly how that mechanism works, because it is crucial to your argument.
Gladly. In a cap-weighted index, your investment is distributed based on the total market value of the companies.
Right.
So if a company's stock price goes up, its market capitalization goes up, and the index is mathematically forced to buy more of it. You are buying past performance.
And right now, nearly 40% of the entire S&P 500 is concentrated in just a few mega-cap companies.
Exactly. Avoiding these drawdowns requires alternative methodologies, whether that means tracking a 10-month moving average to mitigate risk, relying on actual economic scale rather than stock price, or just demanding a wide economic moat and a strict margin of safety. Blindly buying the index means you're mechanically buying a bubble.
Look, I acknowledge that markets undergo periods of extreme valuation. A Shiller PE over 40 is a stark reality.
It is.
However, human nature guarantees failure in any attempt to time the market or apply active interventions. Howard Marks outlines this perfectly with what economists call the nonlinear utility function.
Walk us through what he means by that.
Well, it basically means people's psyches are structurally warped when it comes to money. They care a little bit about a dollar made, but they are terrified by a dollar lost.
That makes sense. Loss aversion is a real thing.
Precisely. Investors inherently buy when the news is good and prices rise, and they panic sell when prices cascade downward. You mention active alternatives, but you must factor in institutional constraints.
You mean the managers themselves?
Right. Money managers are not incentivized to maximize your gains. They are incentivized to avoid career-ending losses.
So they just follow the herd to protect their jobs.
Exactly that. If they make a bad call while doing something unconventional, they get fired. Dave Swenson, who ran the Yale Endowment so successfully, noted that investment management requires non-institutional behavior from institutions.
Which is a conundrum.
Seeing it as an unavoidable reality rather than an anomaly to be traded around is vastly superior to constantly adjusting a portfolio based on moving averages or valuation signals.
But if we both acknowledge that current market valuations are stretched, we have to look at the practical mechanics of how passive funds operate under these specific conditions.
Okay, let's hear it.
Buying a cap-weighted index today is like walking into a grocery store blindfolded and being forced to buy the most expensive items on the shelf, and simply because the crowd is currently bidding up the price of those specific items.
Come on, that is a harsh assessment of a system that has built wealth for millions of people.
But look at the historical data. In early 2000, technology and telecom stocks rose so aggressively they became 45% of the market capitalization.
True.
And this was despite them only representing 15% of the actual economy. When you look at tangible metrics like sales, cash flow, and dividends, cap weighting mechanically held its absolute peak exposure to tech right before the crash.
And the inverse happened in 2009.
Exactly. In 2009, indiscriminate selling drove heavily discounted value stocks, like financials and industrials, down to just 22% of the market's capitalization.
Even though they represented a much larger share of the economy.
Over 38% of the real economy. Cap weighting forced investors to hold minimal exposure right before those specific sectors took off. Passive investing has entirely removed price discovery from equity markets.
I come at it from a different way. You are suggesting that investors or managers can actively circumvent this cap-weighted concentration by applying strict rules, like the 10-month moving average you mentioned.
Yes, a mathematical rule.
But relying on rules inherently relies on human discipline, which inevitably falters.
Why must it falter if the rule is strictly math?
Because terabytes of historical data show that market averages fare better than human-managed funds. Daniel Kahneman's work in Thinking Fast and Slow demonstrates this clearly.
But the math?
Let me finish. To manage a timing strategy, a human must execute the trade. When your 10-month average throws a sell signal, the human has to actually press the button to sell.
Right.
But what if their friends are making vast sums of money in speculative assets? They experience an overwhelming fear of missing out. They abandon the mathematical system.
I see your point, but
The market average, even with its structural flaws, completely removes the human capacity for self-sabotage.
I'm not convinced by that line of reasoning because you are assuming the index itself is a stable, enduring entity. It is not. Corporate lifespans are shrinking rapidly.
How rapidly?
Well, in 1970, the average tenure of a company in the S&P 500 was 35 years. By 2030, projections show it will fall below 15 years.
Wow, okay, that is a noticeable drop.
We are seeing a rapid acceleration in corporate turnover. The strategy of buying and holding the index rests on the premise that the underlying companies have long-term durability.
Right.
So how can a static, blind index succeed over a 30-year retirement horizon when the underlying companies it holds are dying faster and faster? You are anchoring to a buy-and-hold philosophy for entities that do not hold their own value.
That assumes the index goes down with the ship, which it does not.
It does, when you factor in how the funds themselves operate. Index funds operate on forced buying and selling. We are looking at a demographic reality where 75 million baby boomers will soon become net sellers to fund their retirements.
And you are arguing the ETFs will amplify that sell-off.
It's a mechanical process. When a retiree needs cash and sells their S&P 500 ETF, the fund manager doesn't just hold cash in a vault.
Right. They have to liquidate.
They are structurally required to go into the market and liquidate the underlying shares of Apple, Microsoft, and the other 498 companies to meet that redemption. They do this regardless of whether those businesses are thriving.
So you foresee a downward spiral?
If boomers panic, the ETFs sell right along with them. It creates a downward spiral.
That's a well-constructed argument, but have you considered that the increased corporate turnover is exactly why holding the broad index works so well?
How so?
Think about it. The passive mechanism automatically cycles in the new winners while purging the losers without requiring you to predict which is which.
It's an automated process.
Exactly. A company fails and falls out of the top 500. It drops from the index. A new innovator rises. The index absorbs it. The mechanism is self-cleansing.
But what about the demographic selling?
The demographic selling pressure is a valid concern, but attempting to front-run that selling requires market timing, which brings us right back to the behavioral traps that hurt retail portfolios.
But, if that self-cleansing mechanism works as flawlessly as you say,
Why are we seeing so much capital completely abandon the public indices to hide in private markets?
You see that as a failure of the public markets.
I see it as a reflection of the macroeconomic environment. We are operating in an economy sustained heavily by federal deficit spending.
Okay, let's connect the concepts here.
A large portion of that spending works its way into financial markets, supporting asset prices and boosting equity valuations for those who already hold assets. It basically creates a first-class economy with coach-class outcomes.
Meaning the wealth does not translate to the broader public.
Precisely. We see middle-class couples, a teacher and an EMT, who do everything right but are locked out of homeownership because asset prices compound faster than wages.
The housing market is definitely strained.
Meanwhile, private financial markets are eclipsing public ones. In 2021, private markets raised $1.73 trillion in committed funds. Compare that to a mere $434.7 billion in new stock issuances from public companies.
The discrepancy is quite clear.
It is. The public indices, the ones everyday investors are blindly pouring their retirement into, are left with the scraps. The real value creation is happening behind closed doors, in venture capital, private equity, and private credit.
I'm sorry, but I just don't buy that. Let me tell you why. You're portraying them as an arena of superior value creation, but private credit and private equity introduce unmeasured risks.
But they avoid the daily volatility of the public index.
They obscure it. They do not avoid it. Let us examine the opacity of private credit funds.
Sure.
Private credit basically means loans made by non-bank financial institutions. This space has grown to $1.6 trillion in assets under management. It now provides 7% of all credit to non-financial corporations.
That is a substantial piece of the corporate lending pie.
And the average loan size now exceeds $80 million, which is actually larger than the average loan made by regulated banks.
But they aren't regulated the same way.
Exactly. These private loans entirely lack the strict covenants, safety nets, and regulatory scrutiny of traditional banking. Furthermore, this specific market has never been tested in a severe economic downturn.
So how does that risk travel back to the everyday investor?
Through securitization, these asset managers originate the loans, reap the benefits of the upfront fees, and then bundle the loans together to sell the risk to institutional investors.
Passing the buck.
They finance private equity buyouts with floating interest rates operating entirely in the dark. If you think the public markets are overvalued, the private markets are a dark room full of unseen leverage. You have no idea what the true valuations are until a severe economic downturn forces them into the light.
And pension funds are buying into this?
Heavily. Public pension funds are deeply embedded. CalPERS is raising its allocation to private markets to $30 billion. That places the retirement security of everyday public sector workers at unmeasured risk.
The opacity of private markets is a valid concern, but it underscores why central premise beautifully.
How does that help your case?
If public markets are highly concentrated and structurally overvalued, and private markets are opaque and carry unmeasured risk, then the systemic dangers are everywhere. This forces our debate into practical realities.
Right, the real-world impact.
Exactly. How do these factors impact capital preservation, especially for those entering or living in retirement?
You are arguing that passive accumulation is too dangerous for a retiree.
Absolutely. Protecting capital through valuation-based rules is not just a theoretical exercise. It is essential for survival. Look at the lost decade of the 2000s.
That was a rough patch.
From the end of 1999 to the end of 2009, the S&P 500 compounded at negative 1.0% annually. It failed to even outpace inflation.
A very difficult period for investors.
A traditional portfolio of 60% equities and 40% bonds delivered a 2.3% return, trailing inflation by 30 basis points. Retirees simply cannot afford a lost decade because of sequence of returns risk.
Let's clearly define sequence of returns risk for clarity.
Sure. Sequence of returns risk is the danger of experiencing a major market crash right at the moment you retire and begin withdrawing money.
When you need the cash the most.
Exactly. If you retire and the market immediately drops, you are forced to sell shares at depressed prices just to pay for your daily living expenses. Those shares are permanently gone.
You lock in the loss.
And when the market eventually recovers, you do not have the capital base left to participate in the upside. Morningstar's latest data shows that for a retiree looking for a stable income, the safe starting withdrawal rate is now just 3.9%. Mindless accumulation into a cap-weighted index guarantees you will suffer the full brunt of the next prolonged drawdown.
See, I think the investment industry wrongly equates price volatility with actual risk. Volatility is just the fluctuation of prices on a screen.
But it feels like risk.
True risk is the permanent loss of capital, which usually happens when investors panic and sell at the absolute bottom. Warren Buffett states it plainly. He said, "I'd rather have a lumpy 15% return than a smooth 12%.
But a retiree living off their portfolio feels that lumpiness acutely.
They do. But you mentioned the safe withdrawal rate of 3.9%. That specifically assumes an investor demands absolute rigidity in their spending.
Without any flexibility.
Right. The same Morningstar data shows that retirees willing to tolerate spending fluctuations, say cutting back slightly during the down years, can safely withdraw up to 6%.
Even so, avoiding the drawdown entirely would be preferable.
But true risk is missing the eventual recovery. Japan's Nikkei index took 30 years to recover to its 1989 peak, which is a difficult reality. But the U.S. market has historically rewarded those who simply endure.
If you can wait that long.
If you step out of the market to avoid a drawdown using a moving average, you almost certainly miss the few, highly concentrated days of recovery that generate the bulk of long-term compounded returns. Options, hedging, and timing require you to be right twice, when to get out and when to get back in.
That's a compelling point, though. I would frame it differently. Enduring a lost decade because of a steadfast belief in passive recovery is like standing in a torrential downpour for 10 years hoping the weather will clear. Why not just use an umbrella?
Okay, and what exactly does that umbrella look like mechanically?
It looks like rebalancing your portfolio based on actual economic scale rather than just market price. Instead of treating the index like a popularity contest, you treat it like a business audit.
Meaning?
Where the stock with the highest price gets the most of your capital in a normal index, here you anchor your portfolio using tangible metrics, cash flow, sales, and dividends.
So you are severing the link between price and portfolio weight?
Exactly. By doing that, you immunize yourself against the corrosive effect of being overweight in overpriced tech stocks in 2000, or underweight in underpriced manufacturing stocks in 2009.
It's a value-based approach.
During the worst decade for stock returns, a scale-based index methodology achieves superior returns compared to cap-weighted indices. It is not about avoiding all risk. It is about refusing to participate in the most structurally flawed elements of cap weighting.
By demanding a margin of safety.
Yes, meaning you refuse to pay more for a business than its intrinsic value. You evaluate honest management, and you wait patiently.
The umbrella analogy is vivid, but it assumes the umbrella opens perfectly every single time it rains. The operator of that umbrella is still human.
I think a rules-based system limits the human element.
I return to the core behavioral problem. A scale-based methodology or a rule-based system requires an investor to sell assets that have been performing phenomenally well simply because the metrics deem them overvalued.
It enforces discipline.
It requires them to buy assets that are universally hated and plummeting in price. Doing that in a spreadsheet is easy. Doing that with your actual life savings while the financial press screams about the end of the world is nearly impossible for the average retail investor.
You believe the psychological hurdle is too high.
I do. The reason the buy and hold strategy remains superior is not because the market is perfectly efficient. The market is demonstrably inefficient. But the behavioral traps inherent in active management are far more destructive than the structural flaws of the index.
So you default to passive.
Steadfast endurance of volatility, despite the concentration and the macroeconomic concerns we discussed, remains the only empirically proven path to long-term returns for the vast majority of participants.
Well, to summarize my perspective on our discussion today, passive investing has become a structural phenomenon dependent entirely on blind capital flows. When we allow an autopilot system to ignore the actual valuation of businesses, We forfeit price discovery.
And you see the mechanical nature of the index as its greatest flaw.
I do. The market mechanically forces capital into the most overvalued companies at the exact moment they are most vulnerable to a crash. Long-term capital survival requires strict valuation-based discipline rather than mindless accumulation.
We need a margin of safety.
We must demand a margin of safety and refuse to pay 40 times earnings for an index propped up by a handful of mega-cap stocks.
And to summarize my stance, while markets are undoubtedly flawed, occasionally irrational, and currently concentrated, the behavioral traps inherent in active management are far worse.
You view the human element as the ultimate point of failure.
The human mind is simply not wired to execute timing strategies perfectly over a 30-year horizon. We panic, we experience fear of missing out, and we let institutional constraints drive poor decision-making.
It is hard to stay the course.
Steadfast endurance of volatility remains the only path. We must accept the lumpiness of returns rather than constantly tweaking the dials in a futile attempt to outsmart the collective market.
We do arrive at mutual agreement on one core reality. The current economic structure heavily favors existing asset owners, and blind euphoria is always a peril for the unprepared. The financial data offers many layers of complexity that challenge conventional wisdom.
It absolutely does. The tension between the rigid math evaluation and the unpredictable reality of human behavior requires careful, ongoing navigation.
We leave it to you to weigh the evidence and form your own conclusion. Consider whether you are comfortable letting the autopilot fly blindly into the storm, or if it is finally time to take the controls.